Houses are sitting on the market longer. Inventory is growing. Interest rates are skyrocketing. Affordability is at all time lows. The real estate market is going to crash. That is the headline. That is the theme right now. If you look at any magazine, any blog article, if you're watching the news, even recently there was a a news station here locally that went around the downtown area, had our sign in a bunch of the footage, and they were talking about how houses are sitting on the market for so long. And the reality is, if you're a homeowner or you're a home buyer and you're trying to make a smart decision moving forward here with what you're going to do with your investment or your investment capital, you really would like to know whether that's true or not. And we're going to dive into the data and show you exactly today in real time whether or not that's true so that you can plan for 2025 and decide if you're going to stay in your existing home, maybe remodel or renew that lease, or if you're going to go out and purchase another home that meets your needs today or become a first-time home buyer. The data that we're going to look at is going to address some of these headlines. U.S. housing market faces historic decline. Another one here. The housing market is a bubble full of fraud and it's going to pop. Already a couple months past that. But nonetheless, this is where home buyers are at, right? This is the Fannie Mae National Housing Survey, the Consumer Housing Sentiment or Home Purchase Sentiment Index, right? And this measures basically how do people feel about buying homes right now? And you can see consumers are more pessimistic that mortgage rates will go down. So people that think mortgage rates will go down, you can see kind of peaked here around 45% of people just 6 months ago thought that mortgage rates would go down, and now it's fallen by almost 50%. The number of people that think mortgage rates will go down is dropping. People think mortgage rates are just here to stay. We're stuck with it. And so, similarly stay the same, kind of floundering around there. People that think mortgage rates will go up, well, that number is rising, as you would expect that it would. So, this survey that's done by Fannie Mae, one of the government-sponsored enterprises every year, touches on a lot of interesting aspects. But one of the things it's trying to do is it's trying to say, like, hey, here's a snapshot of how buyers feel about the housing market. And you can see right here, they're feeling a little bit worse about the housing market, right? So COVID happened, how people felt about the housing market. People thought, oh my gosh, this is going to be horrible. Before COVID, people thought, hey, market's kind of moving along in a nice clip. We feel pretty good about it. COVID, we're dropping. Then we make some headway. Then those rates up in December 22 start to really get high and spike, and you see it hit an all-time low. And since then, we saw actually some pretty reasonable improvement in market sentiment until recently. And are people just giving up hope? Well, if we dive into some of the components here from February 2025, you can see only about 24% of people think it's a good time to buy. 76% of people think it's a bad time to buy. So a change there month over month of a net good time to buy of +2, year over year +9. Selling conditions, 62% of people say it's a good time to sell. 37% of people say it's a bad time to sell. Home price outlook, 41% of people think the home prices will go up in the next 12 months. 23% think that prices will go down in the next 12 months. 18% thinking that it's a net go up. Mortgage rate outlook, 30% think they'll go down. 33% think they'll go up. So a real split here. Job loss concern, 77% not concerned about a job loss. Again, this is recent, real time, February 2025. A lot of job loss comments going on right now. The components of the home price sentiment index. So this is kind of, you see where they're getting the blend, and then this is the net good time to buy and the bad time to buy, and that's how they get the blended overall. So this is a great tool to see, as an agent, as a real estate broker or real estate agent or realtor, you might go to an open house to get this gauge and just talk to 20 different buyers and sellers that come through. And if you do that for 3 weekends in a row, you have your own home price sentiment index, and you kind of know exactly, just sort of anecdotally, what the market is feeling. But if you're not in the profession, which a lot of people aren't, then this is a really, really good way to get an idea of what do my neighbors, friends, family, coworkers think is happening in the housing market. Let's see if they're correct. So here we are looking at the National Home Price Index. Boy, if the market is about to crash and things are not looking good, you sure would expect to start to see that in prices. But here we are with prices still sitting at remarkable all-time highs. This is the Case Shiller Home Price Index, but all of them are in agreement. CoreLogic, MBS Highway, doesn't matter where you look at. There is strong, strong support broadly in nearly all markets that home prices are not declining. One of the reasons they're not declining is what you see right here happening with the interest rate outlook. Right. So this is a 3 month look, and you can kind of see it's making an arc. And what we're looking at here is 30-year conforming rates, jumbo rates in the light blue, FHA rates in the purple. FHA rates, we've been trying to get the word out. This was sort of thought as a loan for people with bad credit or a bunch of debt or recent bankruptcies. No longer. If you look at the rate differential here between an FHA loan and a conforming loan, it's almost a third of 1%, which is a 3% equivalent on sale price. So a lot of people considering the FHA option because you can get more seller credits if you're putting less than 10% down, and you can also get a lower rate. VA loans, even better, right? VA loans 6.172, a full 0.5% below the conforming loans. So veterans getting a fantastic bargain out there in the marketplace. But, this is a 6 month view here. So you can see, like, before the Fed cut the federal funds rate in September, we were even below this, but the Fed started moving too fast, thinking they'd already won the war on inflation, started cutting the federal funds rate. Bond traders knew better and sent mortgage interest rates higher. But if we look a little bit closer here at and let me clear some of these so you have a better picture. If we look a little more recently at what the interest rate's been doing, you can see we kind of peaked here right around January. And since that January 13th date, we topped out around 7.052 and sitting here today at 6.628. So pretty remarkable movement downward in rate. And this is equivalent of a price reduction on every house sitting on the market. So when that happens, what's the impact across values and prices? Well, let's look and see. But first, we want to look at existing home sales. People talked about what we saw at the end of 2024. We saw existing home sales reach a 30-year low. Fewer homes sold in 2024 than had sold in any year previously for 30 years, all the way back to 1994. So just not a lot of people moving. The interest rate was high, prices were high, not a lot of people moving. So what's happening is some of the journalists and news folks and even lay people are looking at these home sales and they're going, wow, people just aren't moving. The reality, though, we know we have a baseline of existing home sales. This is all pent up demand. These are all people who've been locked in your homes. And listen, some of these people are separated, living with a divorced or separated partner. Some of these people are disabled and are living in a home with a second story they can't ever use or get to. Some of these people are empty nesters and have a massive home, bedrooms they don't ever use. Some of these people have had 2 kids in a 2-bedroom house, 3 kids in a 2-bedroom house. They got 5 people living in 2 bedrooms. This can't go on for very long before you start to see all this pent-up demand hit the market. And what's keeping this demand out of the market has been the high interest rates. But we see interest rates starting to come down, and we know employment directly impacts interest rates. So as we can see, there's been a lot of layoffs, and it's safe to say that as those layoffs start to get reported, that's going to filter in and cause rates to go even lower. So you have this tremendous pent-up demand sitting here for 3 years in the market. You have inventory not rising, right? Like in spite of these prices, in spite of these interest rates, in spite of all the tough economic news, in spite of layoffs, inventory not really rising. We're still today sitting at inventory levels similar to what we were at in July of 2020. Remarkably low inventory levels. Pre COVID, which is your gray bar right here, pre COVID, we were sitting at 951,000 units. Today, still 100,000 less, 847,000 units. So you've got recapping, decreasing mortgage rates, low inventory by any standard, low inventory, decreasing interest rates, pent up demand sitting off the market, stable prices. So where is the crash coming from? That's the question. What is going to cause a crash here? I mean, I guess you could have a massive reversal in interest rates. You'd have to see interest rates get all the way up to 8.5 before we're going to see a crash. You can really see that prices have already started to kind of not increase at those massive rates we were seeing in 2020, 2022, right? We're back to more of a historic 2-3% a year increase. In fact, there's some articles that are saying we've even moved a little bit flat for the first 3 months. So affordability easing as prices are stabilizing, rates are coming down, inventory is low, and prices are high. So no signs of a crash that we're seeing right here. We have mortgage applications jumping 20% week over week. This is real time. This was a March 5th article. Okay. So increased 20.4% in the final week of February compared to the week prior. Refinances increasing 37%, 83% higher than the same week last year. So people thinking that and telling you that the market is going to crash, we're kind of seeing just the opposite happen. We're seeing mortgage activity pick up. We're seeing inventory stay low. Consumer price index for rents, right? One of the things that could really crash the housing market would be if tenants were just getting a bargain in their rents. And this has been the theme for a couple of years where we say like, well, why would I go buy something when, I'm just paying what I'm paying for rent? I can rent cheaper than I can buy. How long do you think landlords are going to give that free ride to tenants? You can see rents have been absolutely skyrocketing as landlords seek to take advantage of tenants in this scenario and squeeze every bit of pricing power they have to raise rents as much as possible. In some cases, 6%, 9% year over year. So when we start to stack all these things up, we start to say, well, can we have a reasonable expectation that prices are going to come down sometime in the next 12 months? I don't think so. I think as we see some price stabilization, interest rates decreasing, rents on the rise, I don't think there's any opportunity for home prices to come down in that sort of environment. What's happening in real time, though? So this is looking at 2023, January through February, median priced home in Orange County, right? I'm throwing a dart at a map and picking a county as a comparison port. But look, Orange County is representative of all of Central Florida. You have Lake County, Seminole County, Sumter County, Osceola County. You have Volusia County, Brevard County, all performing very, very similar. And so what we saw in those 60 days, January 1st to February 28th in 2023, 19 sales completed. We saw a average sale price to list price ratio of 98.1. So 19 homes sold, and sellers are getting about 98% of their list price, and it's taking homes about 44 days to sell. Fast forward to real time today. What we're seeing, sellers are getting about 97.4% of their list price. Okay, so when we compare that, 98.1 to 97.4, so sellers are having to be, 7.7% more negotiable in the forms of probably seller credits. And this is probably more reflective of the fact that instead of just giving all their money to a credit, sellers are now starting to do some price reductions in combination with credit. But nonetheless, we're talking about a very marginal 0.7% difference here in sale price to list price ratio. If this was a buyer's market, you would be seeing average sale price to list price ratios at 95%, 94%, 93%. The other thing to look at is what's the pace of the sales. It's taken 65 days to get to closing or to get off the market to get a contract right now in real time versus in 2019, it was taking 44 days. So it's taking a little bit longer to get to market, but sellers are still getting really high portion of their list price. What about pricing? Same subsection of homes. You have a average sale price of $419,556 in 2023, $419,567 in 2025. So you have prices staying stable. You have days on market increasing marginally. You have sale price to list price ratios decreasing incrementally, but none of this stuff is spelling housing market crash. And the reason that it's so important to review some real-time data is there's a lot of folks out there, there's a lot of money out there that's trying to push you into a rental property. There's a lot of money out there that's trying to keep you out of the market so that large investors and institutional investors can purchase homes at a discount. There's a lot of money out there that is trying to gather clicks and reshares of articles. There's not a lot of money out there that's trying to educate home buyers and educate home sellers about the real market dynamics and what's actually happening in the real estate market. So what we're seeing in real time is sellers are being a little bit more negotiable. Prices are kind of flatlining, but we're going into a busy time of the year in the spring, and we're expecting to see the number of buyers increasing on a daily basis. And the more that rates come down, they're on about a 6-week slide, the more buyers we're going to see coming into the market. So if you're trying to make plans for 2025, I hope you can rely on some of this real-time data to help you make better decisions about what to do, whether you're looking to rent out your house, purchase a new home, get into a better sized home, maybe stay in your home and remodel. But most importantly, if you're renting right now and you're waiting for prices to come down, that's going to be a huge mistake. You're very much risking, if rates fall even more, going out and trying to purchase a home where you saved maybe 1/3% in interest rate, but now you're paying 5-7% more in price. And that can happen really quick. So whatever your plans are, whether you're looking to buy, whether you're looking to sell, whether you're looking to remodel, whether you have a house you want to rent out, we can help you with all those things. Don't hesitate to reach out. I'm Don Harkins with Don Harkins Realty and the Don Harkins Mortgage Team. I appreciate you watching and have a great night.